Hello, welcome back. Here is Ali Talebi, and this is module 18. In this module, we are going to talk about interest rate. So let's start our session. And the first lesson, we'll talk about the interest rate. What do we mean by the interest rate? And also, we'll talk more about the determinants of the interest rate. So which factors actually impact on the interest rate, how the interest rate is determined. I will refer to something which is called term structure of interest rate. It will be just very simple introduction to this concept. Later in lesson 3, we'll come back to this term structure and I will provide you more information. And finally, we'll talk about the money market rates and I will just show you different names and different type of rates which are used in the money market. In lesson 2 and 3, we'll talk more about interest rate, but for now, let's start our first lesson from module 18. So, what do we mean by the interest rate? What is the interest rate? So, like any other commodity or product or service, money is not free. You have to pay for it if you want just to have it. So the cost of money simply is the interest rate. So for example, when you go to the bank and when you borrow $1,000 for the getting money, you have to pay interest for that. Now, the question here is, what factors determine that interest rate? So for sure, you notice in some countries, the interest rate is so high, in some countries much lower. There are three major factors which impact on interest rate. One is the timeline. Are you talking about the 1 month? Are you talking about 6 months? Or talking about 2 year period? So this is the major factor which determines the interest rate. So are you going to borrow for shorter period of time or you are going to borrow for a longer period of time? The second factor is the risk. And when I'm referring to risk, I mean the default risk. So if you are the borrower, you are going to the bank, they will ask you some information, some credit history. So if you are good to go, if your credit score is high, there is a higher chance that you will get the money with a more reasonable rate. Inflation is very key determinant factor actually. In those countries which the inflation is high, and they have a hyperinflation like 20%, 30%. In this case, the interest rate is much higher. So higher inflation will lead to the higher interest rate. So we can put all these pieces together and show the connection, the relationship between those factors and the interest rate using this equation, or we can also use the graph to demonstrate the relationship. As you see on the graph, the vertical axis is showing your interest rate or the nominal interest rate, and your horizontal axis is showing the time to maturity. So as you're expecting, normally as the time is becoming longer, the interest rate is higher. That's why we have the upward sloping term structure. What is the term structure? The term structure is showing the relationship between the time to maturity and the interest rate. So as I mentioned, normally higher or longer maturity, higher interest rate. But we've seen in some cases that as the time to maturity is going up, the interest rate is going down. This is called inverted slope, which sometimes might happen, but it's very rare. The last case was the situation we had last year. So the point here is the people are getting actually very pessimistic about the future long run. That's why actually the interest rate in short term is usually higher than the interest rate in a long run. Anyway, we can break down the interest rate into, as you see, four major components. The real interest rate, that's the major component. And the real interest rate usually is constant over time. But all other factors, actually, they are changing here. Inflation is one of the major factors which determine the interest rate. Higher inflation, you expect to have a higher interest rate. The risk premium or the interest rate risk premium, as you see here, is actually showing the potential or the chance for the investment losses that result from a change in the interest rate. We know the interest rate is changing over time. So if you go with a longer period of time, you're taking higher interest rate risk. Why? Because there is a higher chance that the interest rate will change against your favor or against your interest. And finally, the default risk premium also has impact on the nominal interest rate. What is the default risk? That's the chance that the borrower is not able to pay you back interest or the principal, original money that you lent. Again, this is called the term structure of interest rate, which is showing the relationship between the time to maturity and interest rate. However, remember, the major determinant factors are several items. Maybe you say, Ali, why should I care about the interest rate? Because directly and indirectly, it impacts on the quality of our daily life, actually. For example, as the interest rates are going up, it means the cost of money is becoming more, which means you have to pay higher. For example, most probably you have the credit cards. Most probably you have a type of loan, such as mortgage or car loan. As the interest rates are going up, you have to pay higher interest for your mortgage. You have to pay, the banks are charging more interest on the credit cards. So it's kind of important for you because, as you know, as the interest rates are going up, remember your value of your assets are going down, because we learn in finance that the value of any asset or any investment is based on the present value of all the future cash flows, and you are discounting all these cash flows based on the interest rate. Actually, you're discounting based on the discount rate, and the major determinant factor of the discount rate is the interest rate. So again, higher interest rate, it means lower value for the asset. So it is important to understand the concept of interest rate. It's important to know what's going to happen in the interest rate. Currently, with the current COVID situation, as you notice, the interest rate is much lower than it used to be. So which means that you have better access to some sort of assets, and it's kind of cheaper to get access to mortgage, get access to loan if you are able to get those. Now, Now, let's look at the historical performance of actually T-bill and T-bonds. The T-bill is a good representative of the money market. T-bills are issued by US governments, and they have maturity within a year, 3 months, 6 months, anywhere less than 1 year. T-bonds, treasury bonds are also issued by the US government, but they have maturity which is greater than 1 year. In this example, I'm using the 10-year bond. So this is for those bonds which are expiring or actually becoming mature in 10 years, and the T-bill is actually for the 3 months period. As you're looking at the historical performance from 1960s to almost the current time, this is early 2021, you'll see that there has been lots of fluctuations, ups and downs in the rates. The highest we've seen for the last 50 or 60 years, I would say it's around 1980s, which we had the great economy situation. Everything was doing well. Industries were performing very well. The economy was kind of booming. So the rates were around 14%. However, since then, we'll see the drop in the rates. And as you look at the rates around the crisis, financial crisis, which we had in 2008 and 2009, it was almost, they came to almost zero. And now it is around 1% for the T-bonds, and for the T-bills is almost zero. It's 0.1, less than 0.1% actually. So it's kind of the current situation we are in, and as the economy is performing better, as the outlook is becoming better, we expect to have the higher rates. And again, remember, usually the T-bonds, they have higher rates than the T-bills because we are talking about the longer maturity, and based on what we discussed in the term structure of interest rate, that's why you see that orange actually curve is higher than the blue one. The blue one is a T-bill, and the orange one is actually showing the T-bonds. So when it comes to interest rates, it's important to understand the differences between different type of rates. So let's focus on money market rates. I'm talking about those instruments, those securities which are expiring within a year. One of the major concepts in this market is prime rate. What is the prime rate? That's a basic interest rate on short-term loans that usually the largest commercial banks charge to their most credit-worthy corporate customers. When you go to your own bank, when you're asking, for example, for a line of credit, most of the time they actually quote the interest rate based on the prime rate. So they say prime rate plus 1%, prime rate plus 2%. So that's the variable interest rate they charge. So in some cases also, when it comes to, for example, the mortgage, if your interest rate is not fixed, if it's variable, the quoted rate is based on the prime rate. Currently in Canada, I'm talking about the early 2021, in Canada, the prime rate is 2.45%. In the US, it is 3.25%. That's actually, these rates are amongst the lowest rates since the current situation we are in. So that's just to encourage the economy to boost and improve its performance. Another rate is called FFR, or Federal Funds Rate. What is that? That's the interest rate that banks charge each other for overnight, just one night, loans of $1 million or more. And remember, this is a very low rate. However, as a customer, as a client, you cannot get it. It is just interbank type of interest rate. We have also some other rates which I'm going to refer. So we are talking about the T-bill, or I already talked about the U.S. Treasury bill, or the T-bill, which is the short-term U.S. government debt instrument, which is issued by the U.S. Treasury. The rates usually on T-bills are very low because you know the risk on these. The default risk on these instruments are very low, but it's kind of you're confident that you will get this rate. This is a guaranteed type of rate you will get from the US government. 3 months, 6 months, 9 months kind of maturity or expiry date. We have also another rate which is called LIBOR. That's another famous rate, London Interbank Offered Rate. What does it mean? That's the interest rate which international banks actually charge each other for overnight euro-dollar loans. Maybe say, Ali, what do you mean by euro-dollar? Euro-dollar, that's the US dollar denominated deposit. So when you deposit the US dollar, however, outside of the US, it's called euro dollar. Again, the US dollar deposit outside of the banks in the US, it's called euro dollar. We have also the euro version of the LIBOR, which is called euro LIBOR, which refers to deposit which are now in euros. So when you deposit your money in euro, and we know that's the common currency in the countries in the European Union, and the rates for those is called euro LIBOR. That's it for now. Thank you very much. I will talk more about interest rates in the second and the third lesson. Talk to you soon. Have a wonderful day. Here is Ali Talabi.